Lecture: Evaluating Investment Performance. In this lecture, we'll review the average return measures of a portfolio, introduce several risk-adjusted performance measures, including the Sharpe ratio, the trendness measure, the information ratio, the Jensen's alpha, and the M-square measure. Lastly, we'll introduce the style analysis, including the Morningstar risk-adjusted ratings and the definition of active shares. To begin with, keep in mind there are multiple portfolio management styles out there. The passive management style refers to diversified portfolio with buy and hold strategy and have no security mispricing identification. The second is active management style, which focus on the forecasting of broad markets or individual asset future returns in order to achieve higher adjusted return for the portfolio. The third one involves market timing, which refers to the strategic allocation between risky portfolios and the cash or across different asset classes in order to achieve better fund performance. The performance measure we introduce in this lecture will be applicable for the actively managed portfolio. First, let's review the average return measures of the portfolio without risk adjustment. They include three different averages: the arithmetic mean, the geometric mean, and the dollar-weighted average return. The geometric mean is also called the time-weighted average return. Arithmetic mean is a simple arithmetic average of the holding period return across n periods. In Excel, we use the function average, applying to the net return series. The geometric mean is the compounded period-by-period returns. In Excel, we use the function geomean, applying to the gross return series, which is 1 plus the net return. And the dollar-weighted average return is also called the internal rate of return on investments. We use the discounted cash flow equation, set the present value to be 0, and for each period, it corresponds to the cash inflow or outflow depending on the investment path, and each cash flow will be discounted by the discount rate IRR to the power of the number of periods. Then we will solve for the internal rate of return. For instance, in this example, which we covered before, we have holding period return of 10%, 25%, negative 20%, and plus 20%. The arithmetic average will be a simple arithmetic mean of the four returns, which is 8.75%. The geometric average is the compounded return for the 4 periods, taking the power of 1/4, subtract 1 to get the net geometric mean return, which is 7.19%. The internal rate of return, or the dollar-weighted average, is to solve the discounted cash flow equation in which each period corresponds to the cash inflow and outflow of that period. The initial asset under management is 1, suggesting the initial outflow is 1 million. And in each period, it corresponds to cash outflow or cash inflow for the investors. The last period corresponds to both the cash outflow for the investors plus the asset under management at period end. Then we solve for the IRR, which is 3.38%. Note that 7.19% means that every dollar that's invested at the beginning of the period and hold throughout the 4 quarters is earning 7.19%. However, if we account for different dollars invested with the portfolio, each dollar on average is earning 3.38% per quarter. So that suggests bad timing of the investors because of the cash in, the net flow, positive flow and negative flow to the funds. In this exercise, we ask you to calculate the 3 average returns for the manager who purchased the 3 shares at $90 a share at time 0 and sold 1 share at a time in the next 3 periods. The arithmetic average return turned out to be 3.70%, and the geometric mean return turns out to be 3.57%, and the dollar weighted average return is 5.46%. So here we're taking simple average, here we're taking compounded return, then taking the average geometric mean of this, and finally here we're doing a discounted cash flow model in order to get the IRR for the equation. Next, let's move to risk-adjusted performance measures. We'll start with Sharpe ratio. Sharpe ratio refers to the reward to volatility ratio, or excess return divided by standard deviation of the portfolio. Here, small rp is the excess return of the portfolio. Here, small rp is the excess return of the portfolio. This ratio measures for every unit of total risk of the portfolio, what is the risk premium received by the investors. Therefore, the higher the ratio, the more attractive this asset is. Note that here, when we calculate excess return, we're referring the risky portfolio P as a long-only portfolio. If the portfolio itself is already a long-short portfolio, so RP is the long-short returns already, so we do not need to subtract the risk-free rate. So simply plugging the long-short portfolio average returns here will do the trick. The second risk-adjusted performance measure is called the trenders measure. Unlike the Sharpe ratio, which scale excess return by the total volatility, here trenders measure scale portfolio excess return by portfolio beta. So this measure tells the excess return earned by taking per unit of the systematic risk measured by beta. Again, the higher the ratio, the more attractive the asset is because of the superior risk-return trade-off. The third risk-adjusted performance measure is called the information ratio. So information ratio is defined in the textbook as the alpha over standard deviation of the diversifiable risk, or the firm-specific risk. It measures abnormal returns acquired by taking per unit of non-systematic risk. The book also mentioned that the information ratios might be defined differently in the industry. Sometimes people define information ratio by using excess return scaled by diversifiable risk, or sometimes they refer to the information ratio defined in the book as the appraisal ratio as opposed to the information ratio. But keep in mind, our test we'll focus on the textbook defined ratio. Taken together, the Sharpe ratio is excess return over standard deviation. It is useful when you want to choose one among multiple portfolios to be the optimal or to be the overall risky portfolio. The trendless measure is excess return over beta ratio. It is helpful when you want to rank multiple portfolios, choose those at the top to form an overall risky portfolio. Information ratio here is defined as alpha over residual standard deviation. It is helpful when you want to evaluate a portfolio to determine whether it is a good mix with your benchmark portfolio. The higher the ratio, the more likely this portfolio helps to diversify your benchmark portfolio while adding alpha to the returns. So they serve for different purposes for portfolio evaluation. Next, Jensen's alpha. So Jensen's alpha, as we have learned in the previous lecture, is defined as the actual expected return or the average historical return of a portfolio minus the expected return based on the CAPM or based on the security market line. So here we use index regression model and historical returns of the portfolio as well as the market index to evaluate whether the alpha of a portfolio is significantly different from zero. So we will rely on the statistical significance of the index regression coefficients to determine whether alpha exists. So the Jensen's alpha refers to specifically the abnormal return relative to the single index model, the CAPM. Let's look at this example that applies the four measures in this calculation. So our portfolio P has average return of 35%, beta 1.2, standard deviation 42%, and tracking error, which is another way to call the non-systematic risk or diversifiable risk, sigma E, is 18%. We also have the parameters for the market index M, the risk-free rate to be 6%. So let's start with calculating the Sharpe ratio. Sharpe ratio is the excess return over standard deviation. So we have the excess return, which is 35% minus 6%. Standard deviation is 42%, so our Sharpe ratio is 0.69. Second one is trendless measure. Trendless measure. So let's start with Sharpe ratio. Sharpe ratio is excess return over total standard deviation, total risk. So it's 35% minus 6%, excess return over standard deviation of the portfolio 42%, so Sharpe ratio is 0.69. Trendless measure is defined as excess return over beta. So here we take the excess return, 35 minus 6, divided by beta of P, which is 1.2, we have 24.17%. Jensen's alpha is defined as the average return of the portfolio over the expected return based on the security market line, which is risk-free rate plus beta times the market excess return. So the calculation shows this portfolio P earns 2.6% abnormal Jensen's alpha. Lastly, information ratio, defined as Jensen's alpha over diversifiable risk. So that's 2.6% over tracking error 18%. Information ratio is 0.14. But having the metrics for one portfolio is not very meaningful because we need to use the metrics to compare across multiple portfolios. So here's your exercise. We have stock A and stock B. We have the estimates for the index regression model. We have the R-square, the residual standard deviation, and the standard deviation of excess return. We are given the risk-free rate and the market return, so our job is to figure out the excess return for the stocks and the performance measures for the stock. First, keep in mind that in the index regression model, regress excess return of a portfolio on the market excess return. Therefore, this equation basically tells you the excess return of the portfolio if you plug in the parameters. So we start with calculating excess return for A. Then it's 1% plus 1.2 beta times the market excess return, which is 8%. We do the same thing for A and B. A has excess return 10.6%, B has excess return 8.4%. We're not adding back the risk-free rate because we are looking for excess return. And this equation basically is the excess return. The left-hand side variable is the excess return. So now let's move to Sharpe ratio. Sharpe ratio is excess return over standard deviation. So we do the calculation for both. We have 0.491 for A and 0.337 for B. Therefore, A is more attractive than B if we want to pick just one of them, because A offers a higher return to excess return to standard deviation ratio, higher Sharpe ratio, better risk-return trade-off. For trenders measure, we're taking excess return scaled by the beta 1.2 for A and 0.8 for B. Here, our trenders measure of A is 8.83, less than that of B, which is 10.5, which means that if we want to rank this portfolio, the stocks, and trenders based on trenders measure, B will have a higher ranking than A. Jensen's alpha is estimated based on index regression model. So the index regression model estimate is the Jensen's alpha. So it is 1% for A, 2% for B. Lastly, information ratio. It is the Jensen's alpha over the tracking error. So we take the 1% scaled by the residual standard deviation, 10.3 for A, and we have the information ratio 0.097 for A and 0.105 for B. So if we want to select one of the two portfolios to be the overall risky portfolio, A is preferred. If we want to rank the two portfolios based on their trenders measure, B has a higher ranking. Which portfolio has a higher abnormal return? In the past, it is B. And which one offers a better diversification to the benchmark portfolio? It is B, based on the information ratio. So that's how we use those performance measures. Lastly, let me introduce the M2 measures. So M2 measures refers to the difference of returns between the managed portfolio leveraged to match the volatility of a passive index such as the market. So it's easier to see from the charts. When we try to compare the performance M, the market, versus portfolio B, P, one complication is P and M have different risk levels. So a more fair comparison is to leverage or deleverage P so that P becomes P star, which has the same total volatility as the market portfolio. Then we can look at whether P star outperform or underperform the market to measure the attractiveness of portfolio P. Therefore, M squared is defined as the average return of P star, which is the matching portfolio to M based on the volatility by deleveraging P, minus the return of M, the market portfolio. And this return difference is equivalent to sigma M times the Sharpe ratio difference between P and M. Okay, so it's intuitive because you can see sigma M is the horizontal axis, the distance, and SP minus SM is the wedge between the two capital allocation line. So that gives you the distance between M and P star. In addition to calculate abnormal returns based on the single factor model, which we have the Jensen's alpha, we also introduced in the past the abnormal returns or the alphas relative to multiple factor models, such as the Fama fringe factors or the Fama fringe of 3 or 5 factors. So here, the estimated alpha is called the Fama fringe 3-factor alpha, and here it is called the Fama fringe 5-factor alpha. And we do this in an index regression model by including multiple index returns. For instance, if we have portfolio P, Q, and M, what we do is to use the historical monthly returns, in this case, using the historical monthly return over the last 12 months. Then we calculate the Sharpe ratio for P and Q, M squared for P and Q, as well as alpha beta trenders measure, tracking error information ratio. Then based on our investment purpose, we can select the relevant performance measure to determine whether P is better than Q or not in serving the purpose of our investments. If we want to choose the optimal or overall risky portfolio, Q will be preferred. If we want to choose a portfolio that's outperformed the market, Q will be preferred. And Q also has the higher risk-adjusted return, but it is riskier. And the trenders measure suggests that we can rank Q above P when we select multiple portfolios to combine together. Okay, so that's how we use those performance measures. Next, let's move to style analysis. So what is a style analysis? It's a tool to systematically measure the exposure of a managed portfolio relative to asset classes, which we call style returns. Okay, you can only apply this analysis to active funds, not passive funds. It was initially introduced by Professor William Sharpe, and he shows that 91.5% of the return variations in mutual funds can be explained by the fund's asset allocation to treasury bills, bonds, and stocks. Okay, and this results has been confirmed in later studies as well. We want to use a case study to illustrate how style analysis is done. Here we have the famous Fidelity's Magellan Fund, which was run by the famous stock picker investor Peter Lynch. He was the portfolio manager of the Magellan Fund from 1977 to 1990, and he retired in 1991. During his tenure, the fund has outperformed S&P 500 in 11 out of 13 years and earning 29% annualized return, which nearly doubled the returns on S&P 500. As you can see that initially, right, this is the initial period, and the fund has outperformed the market substantially. And after the retirement of Peter Lynch, the fund has some fluctuation for multiple years due to manager change, but in the recent 10 years, the fund has performed quite well. So if an investor who has invested $1,000 with the fund in its inception in 1963, the $1,000 would have grown to $11,478 when Peter Lynch took the office, and that $1,000 would have become $306,000 in 1990. And today, the $1,000 would be worth $4 million. So it's a stunning performance. Okay. So the interview of Barron last year asked the question whether Peter Lynch has beaten the market. The answer from Peter Lynch is to tell a story of his return performance through the history of his late wife's IRA, which he managed. And she put in $750 a year into the portfolio from 1974 to 1978. And that portfolio has given the Lynch family $3 million withdrawal for weddings, graduation, honeymoon, and when the wife died in 2014, the portfolio still had $8 million, even after the $3 million withdrawals. So Peter Lynch has increased the account balance by over 350,000%, or it is a 3,500 better, and that the account eventually went to the Lynch Foundation. Another article also reviewed the story, says Peter Lynch's ability to turn $3,750 into $11 million in his wife's IRA is inspiring and motivating story. And this unexpected interview with Peter Lynch just made my day. Looking back at the performance of Peter Lynch during his tenure at Magellan Fund, and where did he make all this money? So the style analysis requires the regression of his fund return, excess return, on returns of multiple asset classes or style portfolio returns, including the treasury bills, the small cap returns, the median large cap returns, the growth portfolio returns, the median PE portfolio returns, and the value portfolio returns. So in essence, it's the treasury bill with the size and the size factor and the value factors in different category. The estimation shows that 35% of the return variation of Peter Lynch's fund comes from the median cap exposure, 61% comes from the large cap exposure, and 5% comes from the growth fund portfolio exposure. Altogether, the three styles, median cap, large cap, and growth, accounted for 97.5% of the return variation. In addition, So basically, the results show the fund returns are well represented by the three style portfolios. Also, the intercept with alpha is 0.32% per month, which is roughly corresponding to 4% per year. That's also sizable. Abnormal returns for a 5-year period is close to 20%. So in short, the style analysis can tell us where the exposure of the portfolio is and whether the portfolio used the style returns to obtain superior or obtain performance. A more recent way to incorporate the style analysis is the Morningstar's risk-adjusted rating. It is widely used by evaluating mutual fund performance in the industry and by investors. So Morningstar ranks companies in their peer group based on Morningstar's style definitions. Then Morningstar calculates the risk-adjusted performance ranks across the funds in a given style group. And then they come up with the risk-adjusted ratings, or RAR. Based on the RAR ranking, they would assign the bottom 10% with a 1 star, the 10 to 32.5 percentile with 2 star, 32.5 to 67.5 percentile with 3 stars, and 67.5 to 90 with 4 stars, and 90 to 100 percentile with 5 stars. So the more star the fund is, the higher the style adjusted or risk adjusted performance the fund has for the given period in time. So basically, after the RAR is calculated, okay, the funds will be placed into different bins. You can see that the corresponding Sharpe ratio also lined up pretty well against the RAR, which reinforce the usefulness of the RAR of Morningstars. Let's look at an example. This is the T. Rowe Price Health Sciences Fund with the ticker symbol PRHSX. The Health Sciences Fund has a 5-star rating, which is the overall Morningstar rating, 5-star, out of 136 funds in its category. Okay, something like health science, also based on the size and book to market category. And it has multiple ratings depending on the sample period we're looking at. So based on the most 3-year performance, the fund is given a 4-star rating. Based on the last 5-year performance, the fund has a 4-star rating. And based on the last 10-year return, the fund has a 5-star rating. So overall, the fund has consistent risk-adjusted performance in its given style, suggesting the relative stable and superior management skills of their management teams. Another recently used performance measure, which is not introduced in the book, but started to become very popular industry, is the active share measure. So I'm going to introduce the active share measure here and give you an example. So active share is a measure on the scale of 0 to 100. It's proposed by Kremers and Patagisco in their 2006 article. This active share measure, tells you how closely a fund's holding correlate to companies in its primary benchmark index. Basically, it tells you how different or similar the holding of the funds relative to the holding of the benchmark index. It's defined as the sum of the absolute different deviation of the weight of the fund in a given security relative to the weight of a given security in the index portfolio. And if there's deviation, the deviation will be signed as positive, and this is the total deviation across all n securities divided by 2. So when you see an active share equal to 0, it means the fund is essentially in an index portfolio because it has 100% the same holding as the index portfolio. But if the active share is 100, it means that the fund has no common holdings with the benchmark. And so the higher the number, the more active the managers are in managing the funds. So this helps you to diagnose closet index funds, which refers to funds who claim that they are actively managed a portfolio, but in fact, they simply buy and hold the index component securities. So that you don't want to purchase those portfolio who charge you a high fee by essentially giving you the index portfolio. So as an example, how this active share is used, you can see that for the same portfolio we introduced previously, the T. Rowe Price Health Sciences funds, now T. Rowe Price reports a lot of risk, a lot of performance metrics, alpha, beta, R-squared, standard deviation, turnover, and also it reports the active share at the very top, which shows the prominence of this measure nowadays. This fund has an active share 91%, suggesting the managers are highly active and their holdings are quite different from the holdings in the benchmark portfolio. So the benchmark portfolio is include two. One is the Leaper Health Biotech Fund's average return, or the SP 500 index. You can see that the funds invest in different securities because it invests not only domestic securities but also foreign stocks, convertibles, and preferred stocks. Okay, and its performance in the last year outperforms the benchmark, and in the last 3 years outperformed the benchmark, last 10 years, and outperformed the benchmark. So that's why it's a good portfolio to consider for health sciences. Lastly, I want to remind you some caveats of using the performance measures. Okay, so far the performance measures we have introduced do not consider portfolio compensations are changing due to market timing of the management. Okay, they assume funds maintain a constant level of risk. Okay, and they do not consider funds who engage in active asset allocation. And also, in large universe of funds, some of them may end up having an attractive performance measure, not because the managers have a superior ability of managing money, but because they are simply lucky by chance. Lastly, because we have the survivorship bias, so there will be an upward bias in average fund performance because we do not account for failed funds over the sample periods. So those things we want to keep in mind when evaluate portfolio performance. Okay.